Hey everybody, my name is Jessica Davis and I'm the editorial director of ChannelE2E. I'm here with Bruce Teichman and Rick Murphy of Cogent. Cogent, tell me the full name of the company, guys.
Cogent Growth Partners.
Cogent Growth Partners, that's right. Cogent Growth Partners. They're an investment banker. They match MSPs with buyers and do an amazing job of that, and because of that, they have a unique perspective on the marketplace for managed services and valuations and all kinds of things that MSPs need to know about in terms of improving their businesses. And I wanted to start out today by asking a question. I know everybody talks about EBITDA when it comes to M&A and valuations. And I've heard an alternative viewpoint from you guys, and I wondered if you could talk about that, why GAAP accounting is important.
Yeah, you want me to go first?
Please.
Sure.
Yeah. Well, yeah, besides, Rick has a presentation called EBITDA Schmebida, so he could dig in a little further on that. But really, for me, what we find that is very challenging is there's a lot of MSPs, I mean, probably the majority that are doing cash accounting on their books. And what that really means is, when the money comes in is when they book the cost, as opposed to the period in which it is attached. So you sort of have revenues coming in, but costs are often in different months. And it's very, very difficult to go, hey, what do you make every month? What do you make in January versus February? It's all this sort of timing issues. And you can do cash for your taxes, that's going to be the case. But you really should do accrual accounting, which is mostly GAAP-ish. There's some rules around that. And that means that you're booking your cost if you were to invoice, and we'll just use product as a simple example, right? But if you were going to invoice, a product in September to your customer, the COG around that product should also be booked to your accounting system in September. So you can see this is what came in. This is, well, cost of goods.
What's a COG?
Yeah, thank you. Yes, cost of good. And if it's service, then of course, the service dollars are being billed in a particular month, and all the service labor against it should also hopefully be, in that same period. And so that's really the accrual versus cash. And it's a big challenge when people are doing cash accounting, like I said, to really understand, hey, what's the company genuinely doing from a month to month, quarter to quarter, year to year period. There's a lot of, hey, in December, I'm gonna, maybe put in this cost, but I'm not going to invoice till January, so I can sort of reduce my profitability. There's some tricks of the trade, if you will. But honestly, it hurts these companies to do that, because even if banks are looking at their profitability in order to lend them money, you want to have the most realistic picture you can. The challenge with EBITDA, right, which is earnings before interest, taxes, depreciation, and amortization, as they call it, right, is this ITDA, the interest, the taxes, the depreciation. First of all, in a lot of MSPs, and we'll just speak to that, the difference between EBITDA and maybe just cash flow is not that, or net income is really very close, because there is not a lot of, hardware and depreciation and hard assets and things that adjust it. But for those businesses that do have it, where they're doing, hardware as a service, where they have a private cloud component, where they have those things, it is really, it offsets again for the tax man that, hey, my profit's actually higher, but the actual cash effect and what the company genuinely made, it's really misleading. It can be very misleading with EBITDA, and that's why, according to GAAP, generally accepted accounting principles, EBITDA is not a GAAP measure, kind of for that reason. And Rick, if you want to sort of go deeper there, or
I want to hear about the Schmebida part.
Well, the Schmebida part is a couple of things, and Bruce swept that up very nicely. Thank you much, Bruce. Just going from what you just said, the Schmebida part of that is, there's a cash flow component to it. And I think a really good example is something called deferred revenue, which a lot of business owners that are doing cash accounting don't really employ, whereas I've taken in a deposit. Let's say I have an annual client, I'm billing them annually. and they paid me $20,000 for my annual service. I'm not going to bill them again for another year. And it doesn't matter what month I bill them in. I took all that money in, and then I haven't delivered the service yet. So I'm going to be delivering my monthly services times 12, right? 12 months forward. And so that money should actually be housed on their balance sheet, which the big thing with GAAP accounting is paying a lot more attention to your balance sheet than paying attention to your profit and loss statement, or income statement, as some people call it, right? So, the issue there is when you're just focused on your P&L, your balance sheet's not telling you anything. You're not learning anything from your balance sheet, and a lot of people don't book that deposit, that $20,000 deposit, on their balance sheet, and then every month that they do service, you draw that into actual earnings. You draw that into actually income on your P&L. So you didn't earn the $20,000 today. So it doesn't. So you can see where that would also artificially inflate a perception of profit. It would artificially inflate a perception that I made some money this month. I could take some money out to the company for myself as an owner, or pay some bonuses, or pay a commission on that money. So I'll give you a really good example. Nobody would pay a commission on an annual payment, a prepayment, because you haven't delivered the services yet, and that client could still cancel. You might owe them a refund. There's a lot of people that don't book it that way. So that's a really good example of what we see as a difference, but where business owners just don't understand the difference between GAAP accounting and cash accounting.
Interesting. How many MSPs that you work with make that mistake? Or
almost all of them.
Yeah. Okay.
I was going to say a pretty high number, 80%.
I'm going to go greater than 80%. I think would be making it. And mistake is just is how they look at it.
Yeah, that's the wrong word. Yeah.
Well, I could put it a different way, but I don't want to create any issues. But the idea that you're thinking about tax accounting when you're operating your business is not how you should think about accounting. You should be thinking about accounting from how's your business profiting? How's your business doing? Are you controlling expenses? How am I making money? And if you're not making money, why am I not making money? How could I make more money? And again, sharing that with your team or whatever else you're going to do with that is where GAAP accounting can be really helpful, because you understand it ties it back to cash flow. And most people, again, when they're looking at their P&L, their cash flow is just looking at their bank account. Do I have any money in the bank? How much money do I have in the bank? They're really proud about I can keep money in the bank, but that's not money in the bank's not cash flow. It's a result of cash flow. But did you pay the bills you're supposed to be paying? Does that money come from prepayments and other things that should be on deferred revenue? So that money should be in a savings account or someplace else. So you can't put it in your regular checking account and accidentally spend it on a new whatever you want to do with it. So that's a big reason that EBITDA hides that. EBITDA is a proxy for free cash flow in the absence of debt and other issues. So if the company doesn't have a lot of debt, which most of them don't, if you're not buying a bunch of equipment, you don't own it, you don't have to refresh a data center. So a lot of these companies are fairly nimble in that way. So EBITDA is a proxy for free cash flow, it's a conversation starter, but it doesn't take into consideration your balance sheet, which is why it's not GAAP compliant.
Makes sense. Well, thank you for that perspective, you guys. Really appreciate it. And while I have you here, just wanted to also check in with you both. So it's 2024 is kind of a different kind of year so far. We've still got some inflation. I don't have a good sense of how the deal flow is going so far this year, but I wondered if you might provide your perspective on are deals picking up this year? Where are we going with that? What's your sense of 2024 so far?
Go first this time, Rick, if you want to.
Sure, I'll do that. So as far as a forecast for 2024, how's it been going for 2024? It's definitely been a different year. There's just a lot of talk about interest rates, but we don't really see it affecting a whole bunch. The people that rely on a lot of lending to get deals done, well, that's slowed them down a little bit. It's cost them more money. They're being a little more circumspect on price point. I think it's probably taken the top off the market in a bit in terms of some egregiously overpaying deals I've heard of in the past, although we haven't participated in them. I think that every deal is taking a little bit longer to get done, whether it's because the people that are doing the purchasing, a PE company, for example, private equity company, for example, who might be using some lending leverage as part of the transaction costs in a transaction. Their lender might have different covenants than those covenants used to be a year ago, 2 years ago, when money was a lot cheaper. If you think about the interest rates themselves and just the same exact covenants that were previous covenants, without adjusting those covenants, well, then the higher interest rates actually don't work, so they have to renegotiate the covenants. So that takes time. There's got to be good purpose behind it, and also I think increased in length in the due diligence process. We're seeing deals are taking longer to gestate. We're getting deals also done where we've, with customers, candidate companies that we've talked to years ago, because they just weren't ready yet, or they just weren't big enough for their own desires to move on. So I think the market is still very fervent. It is still a seller's market, in my opinion. Bruce, you could speak to that. I think that it's a good time to be a seller, and it's also a good time to be a buyer because you've got good companies that have matured, and you've got a operational maturity level that is significant. That's worth adding onto your business. So we are also running to everybody wanting to be a buyer. That has definitely been happening more so than I can remember in even the near past. Every company I talk to wants to learn how to buy companies, even though some of them shouldn't be.
Interesting.
So
we're gonna circle back on that one and talk about that one next time around, you guys. Everybody wants to be a buyer. How can you be a buyer? That's right. A great topic. All right, Bruce, tell us what you think.
The other thing I'd add, just in terms of state of the market, this year compared to last year, as Rick said, for those that are relying on borrowing, obviously it's slowed them down a little bit, but by and large we haven't seen that much of a change from a valuation perspective. The MSPs over the last several years have been sort of upticking a little bit on what somebody's willing to pay, and that I think has definitely leveled off. Probably started middle of last year. It's just not climbing anymore, but it didn't drop so much. And I think the reason it didn't drop, nothing to do with interest rates, is that there are just less quality MSP. It's sort of a supply and demand over the last 5 years. So many of those better, larger organizations have been already acquired. They're part of some portfolio, whether it's a strategic buyer or private equity. And so, there's just less quality out there, and I think the buyers are looking for that too. Back to, and maybe it is a little bit the interest rates and the cost, right? They're being more scrutinizing, and they're looking for those better businesses, and because there's less of them. So the other thing, though, if you're not very sophisticated, if you're not making good margins or growing, quarter over quarter pretty, regularly, up and to the right, as they say. I think the market has lowered for those guys, right? Like it stayed high for the good quality firms because they're just in demand, right? It's not rocket science, but that's definitely happened. And the other thing that's going on that's keeping it there is, to Rick's point, so many buyers, so many knocks on the door. So picture, you're in the foyer negotiating to sell your house with somebody, and literally on all the windows around the room, everyone's knocking. And it's someone, they may be unqualified, but you're, in terms of negotiating with who's in front of you, you're like, well, all these, I should, it's slowing things down, and sometimes to the point of interfering with deals getting done. Obviously, that can happen.
Excellent answer. And there's another topic for our next time around, which is how do you become a quality MSP? I think.
Yeah.
Yep, I think so too.
That's a great topic.
All right, so
there's definitely answers there.
Tune in next time for when we talk about those great topics coming up. Thanks so much to Rick and to Bruce today for talking to us today about what's going on in the market and GAAP accounting versus EBITDA. Which one should you focus on? I think those are important topics. Thanks, you guys.
Yeah, thanks.
Thanks, Jessica.